Silver trades at $68.10 in Singapore right now, up from Friday's close at $66.50, with bids stacking aggressively in a market that should be dormant on a Sunday night. That's not volatility, it's fracture. Physical premiums in Shanghai have spiked 15% above spot in the last 4 hours, while COMEX futures lag, creating a $2 disconnect that screams arbitrage failure in a system designed to prevent it. Industrial buyers aren't waiting for confirmation. They're hoarding whatever granules or bars they can secure before shipments halt, turning a routine overnight session into a scramble that exposes the West's vaults as critically depleted. London's LBMA inventories down to historical lows. New York's deliverable stock eroded to bare minimums. This isn't a blip. It's the live unraveling of a supply artery that sustained global deficits for 5 years straight. The leaked directive from Beijing's Ministry of Commerce isn't rumor. It's operational, locking exports behind a licensing wall, with 0 approvals issued for the first quarter of 2026. Observe the asymmetry. Global mines pull 840 million ounces annually, but consumption hits over a billion, leaving a 200 million ounce hole that's been patched by draining Western stockpiles and reversing flows toward China. Now, with 15% of refining capacity, 126 million ounces equivalent, trapped domestically, the effective Western deficit balloons past 300 million ounces. That's more than the entire annual output of the U.S. Mint's Silver Eagles program vanishing overnight. The logic breaks here. If the system were stable, refiners would reroute, premiums would normalize, but instead, we're seeing Korean electronics firms and Japanese refiners outbidding each other in panic, indifferent to price because shutdowns cost millions daily. This mirrors 2022's gas cutoff from Russia to Germany, where energy prices didn't just rise, they redefined industrial viability. Back then, pipelines closed and factories idled. Now, silver's the conduit, and solar dominance hangs in the balance. I track these signals not as isolated events, but as convergence points where market mechanics fail under strain. Consider the leasing arrangements. Credible reports indicate J.P. Morgan secured 4,000 tons, 130 million ounces, from China's ICBC in October, a bridge loan to mask Western shortages. But loans demand repayment, and with exports freezing January 1st, that metal can't cross borders without a strategic exemption that isn't coming. If it's already returned, Western vaults empty further. If not, banks face default cascades. This isn't speculation. It's the observable pivot where U.S. banks flip net, long per the latest CFTC report, abandoning shorts while foreign institutions piled into over 200 million ounces short. They've positioned for the squeeze, leaving outsiders exposed. The system loses stability precisely at these handoffs. Paper promises multiply, but physical delivery stalls, echoing the 2010 rare earth embargo when China withheld 97% of global supply, forcing tech relocations and price triples. If you follow commodity flows or work in supply chain logistics, how does this reversal look from your vantage? Does it align with what you're seeing in real-time shipments? Share your observations in the comments. It could clarify where the bottlenecks are tightening most. Deeper in the fracture, industrial demand isn't abating. Solar panels alone devour silver paste at rates unseen before 2020, with EVs, 5G towers, and AI data centers compounding the pull. We've sustained this by cannibalizing old stockpiles, remnants from when silver was monetary bedrock. But those buffers are gone. The anomaly sharpens. Prices held at $25, then $30, $40 through deficits because Eastern surpluses flowed west. Reverse that, and the illusion shatters. Geopolitics interlaces here. China's 80% grip on solar modules isn't accidental. It's strategic, viewing silver as too vital for export in a fracturing global order. This lockdown signals resource nationalism, much like Russia's gas weaponization, but subtler. No overt threats, just bureaucratic seals that reroute industry, build factories in China, or face blackouts in production lines. The West's energy transition, reliant on imported panels, now contends with a raw input blockade. History reflects this breakage without dictating it. In 1979 to 80, the Hunt brothers' corner attempt spiked silver to $50 amid shortages, but that was speculative. Today's driven by inescapable consumption outpacing extraction. The difference erodes confidence. Then, regulators intervened with margin hikes. Now, silence from overseers amplifies the void. Media downplays geopolitical tensions, or rumors. But the document's language is unequivocal. Strategic necessity exemptions required, none granted. This isn't policy tweak, it's severance. Logistics compound. Shipping lanes from Shanghai to London, once fluid, now face indefinite holds, mirroring how 2022's gas halt idled German chemicals. Where the system buckles, banks can't print bars, only contracts, and industrials demand physical, not derivatives. Tracing back, the reversal began 6 months ago. Western inventories dipped below safety thresholds, forcing the borrow from East. But why the urgency now? Beijing sees the dollar's erosion, geopolitical rifts widening. Holding silver internally secures dominance in renewables and tech. It's not malice, it's calculus. The 130 million ounce lease was a lifeline, but with repayment colliding against the ban, it becomes a noose. Foreign banks' 200 million ounce shorts, they're the canary, facing margin calls as prices vault. Attempts to double down fail against physical scarcity. Covering drives bids to $70, then $85 in vacuum trades. This isn't growth, it's rupture, where thin order books yield vertical spikes defying charts. For those in finance or tracking CFTC data, the U.S. banks shift to net long, while foreigners deepen shorts raises questions. Did insider ties tip them off? If you've analyzed similar reports, interpret this divergence in the comments. Your take might reveal overlooked patterns. Symptoms manifest first in Asia. Sunday's jump from $66.50 to $67.90 at open, climbing to $68.10 amid low-volume frenzy. Not retail, sleeping in Europe, but corporates. Malaysian solar producers, Korean chip makers securing stock before the window slams. Price becomes irrelevant. $68 is cheap against factory halts. This transitions the market from speculative to scarcity-driven, where buyers procure because survival demands it. Interweave military angles subtly. Silver's role in electronics extends to defense. Missiles, radars, making stockpiles national security. China's hold echoes Cold War resource hoards, but inverted. The exporter becomes guardian. The math condemns stability. Baseline deficit, 200 million ounces, plus 126 million trapped. 300 million shortfall for accessible markets. No equilibrium at $67. Clearing demands $100 or beyond to curb demand. But en route, fractures deepen. Force majeure clauses in futures could trigger, settling paper and cash at suppressed levels, while physical premiums balloon 50 to 100%. Own bars, secure, hold ETFs or contracts. Risk evaporation. This bifurcates reality. Paper illusion versus tangible asset. Banks knew, hence the long pivot, positioning for delivery claims. Outsiders, left in the synthetic trap. Geopolitics refracts through industry. Germany's energy Wende leans on Chinese panels, now starved of silver input. Relocation isn't swift. It demands years, capital. Meanwhile, blackouts in supply chains. Compared to 2010's rare earths, prices surge 400%, forcing diversification. But silver's ubiquity, solar to EVs, amplifies impact. The system erodes at dependencies. West borrowed time. Now repayment coincides with closure. If you're in renewables or manufacturing, the projected 15% supply cut, how does it hit your projections? Note in the comments if you're already rerouting or facing delays. It builds the fuller picture. Nonlinear threads converge. The lease's end date aligns with the ban, suggesting orchestration or foresight. Silence from regulators, a signal of complicity or paralysis. Media's spin, China rumors, mask the directive's clarity. But data doesn't lie. Inventories low, premiums high, bids frantic. This isn't crisis onset, it's midpoint, with Western banks insulated, foreigners exposed. History as mirror. 1980s spike collapsed under intervention, but today's deficits are structural, not manipulative. No easy fix, no untapped mines, no substitute scaling fast. The lockdown enforces reality. Silver's era as cheap input ends. Phase 1. Breach $70 this week. Volatility extreme as Asia's pressure overwhelms. Phase 2. $85 vacuum. Liquidations cascade. Phase 3. $100, where economics bites back, destroying marginal demand. For viewers monitoring Asian sessions, that overnight $1.60 leap. Does it match patterns you've seen in prior shocks? Share your chart reads in the comments. Contrasting views sharpen the analysis. Logistics interlock with military. Silver's conductivity makes it irreplaceable in high-stakes tech, from drones to satellites. China's retention bolsters self-reliance amid tensions, much like Russia's gas leverage. The West's pivot to domestic mining lags years behind need. Anomalies pile. COMEX deliverable at troughs while demand peaks. Unsustainable. The fracture widens. Foreign shorts at 200 million ounces face no sellers. Samsung buys mines, China hoards. Covering bids escalate, creating the super spike. No technical resistance in scarcity mode. If you've dealt with commodity squeezes historically, the foreign bank's exposure here. How comparable to past traps? Weigh in below with your parallels. It tests the model's robustness. Causes surface late. The directives leak 4 hours ago ignited, but roots in 5-year deficits, geopolitical recalibration. Beijing's move. Not blockade, but prioritization. 80% solar share demands input control. West's response? Scramble, but vaults echo empty. Final phase fixes. The process advances, separating holders from pretenders. No reversal. The lockdown embeds, reshaping flows. Stability lost at the export gate. Deficits compound. Prices seek truth. The system's recalibration is underway. Cold and inexorable. One last point for those in geopolitics or resource strategy. China's zero exemptions for Q1. Intentional signal or bureaucratic lag? If you've parsed similar policies, interpret it in the comments. Your insight could map the next moves. Silver sits at $68.88 this morning, up another 2.5% overnight, with the COMEX open, seeing bids push through $69 before pulling back slightly. That's not correction. It's acceleration. Registered COMEX inventories have drained over 47 million ounces in the first weeks of December alone, leaving deliverable stock at levels that expose the paper market's fragility against physical claims. Premiums on physical bars and coins now exceed 30 to 50% in major dealers, while futures trade as if supply were abundant. This divergence isn't noise. It's the system's core contradiction manifesting in real time, where industrial users and hoarders pull metal out of vaults faster than leases or imports can refill them. The Ministry of Commerce directive, effective in 9 days, mandates licenses for all silver exports through 2027, with qualifications skewed towards state-aligned giants producing over 80 tons annually, effectively gating flows that once bridged global deficits. Trace the rupture deeper. Mines yield around 820 million ounces yearly. Recycling adds marginal tons, yet demand holds near 1.2 billion, sustaining a fifth consecutive deficit, projected at 117 to 149 million ounces for 2025 per the Silver Institute. China's refining dominance, processing flows that account for 15 to 20% of accessible Western supply, now prioritizes domestic needs, trapping equivalent volumes behind bureaucratic thresholds. No outright ban, but the mechanism achieves similar restraint. Smaller refiners sidelined, approvals discretionary, outflows calibrated to internal strategy. This isn't environmental rhetoric, it's alignment, securing input for 80% of global solar production amid widening geopolitical fractures. Western transitions, solar buildouts, EV scaling, data centers, depend on panels and components that devour silver paste. Yet the conduit narrows precisely as consumption peaks. The asymmetry sharpens in logistics. Early December saw frantic front-running, with Asian industrials, Korean chip fabricators, Malaysian module assemblers, securing granules before thresholds bite. Price indifference defines scarcity mode. Factories idle at millions daily loss, rendering $70 an acceptable hedge against zero. History echoes without repeating. 2010's rare earth throttle tripled prices, forced tech migrations. 2022's gas pivot redefined European industry. Silver's ubiquity amplifies. Conductivity irreplaceable in high-efficiency cells, defense electronics, AI infrastructure. Retention here isn't retaliation, it's foresight. Retaining leverage in a multipolar recalibration where resource control dictates industrial sovereignty. If you're tracking physical flows or dealer premiums, how acute is the disconnect in your region? Dealers rationing, wait lists extending. Drop your ground-level signals in the comments. They map where the strain concentrates. Interlace the banking layer. Western institutions, facing vault depletion, leaned on Eastern leases. Hundreds of millions ounces bridge shortages, post-2020 deficits. Repayment windows now collide with licensing gates, turning temporary patches into permanent exposures. CFTC data through early December shows managed money piling long amid volatility, while commercials hedge downstream risks. The pivot manifests. Those with Shanghai ties anticipated the shift, positioning for delivery claims. Outsiders hold synthetic exposure in a market tilting physical. Force majeure lurks in fine print. Exchanges could settle contracts cash at capped levels if delivery proves impossible. Bifurcating outcomes. Tangible holders insulated, paper claimants diluted. Geopolitics threads through without dominating. Silver's critical designation underscores dependency chains, where export administration becomes policy tool. No dramatic cutoff, but graduated control. Quotas implicit in approvals. Reroutes investment. Build locally or import finished goods at premium. The West's green mandates contend with input sovereignty elsewhere. Deficits compound. Baseline 100 to 150 million ounces annually, plus gated refining. Yields effective Western shortfalls exceeding 200 million. Math erodes equilibrium. $68 to $70 holds only if demand destructs first, but solar thrust and tech inexorable. For those in solar or EV supply chains, the licensing thresholds. How are procurement teams adapting, shifting to domestic sources or stockpiling? Share your rerouting insights below. It clarifies adaptation velocities. Symptoms cascade into vaults. London's LBMA saw outflows mirror COMEX drains. Premium spike as arbitrage windows close. Asian sessions lead the charge. Overnight volumes thin yet aggressive. Corporates bidding indifferent to levels. This isn't speculation, it's preservation. Military overlays subtly. Conductivity vital in radars, missiles, satellites. Stockpiles dual use. Retention bolsters resilience amid tensions. The process embeds. No swift reversal. Licenses favor alignment. Flows recalibrate eastward. Prices seek clearing levels. $80 vacuum trades, $100 demand curb. While physical commands escalating premia. System loses cohesion at the gate. Paper multiplies claims, physical rationed. Phase advances, separating resilient from exposed. If you've parsed MOFCOM directives historically, the state trading qualifiers, protective facade, or effective quota, interpret the thresholds in comments. Your parallels test intent depth. Deeper convergence. Deficit structural since 2021. Cumulative near 800 million ounces, drained from above-ground stocks. Buffers exhausted. Reversal enforces discovery. Industrials thrive on conductivity. Thrifting marginal, substitution lagging. West mining revival? Years delayed. Permitting choked. Anomalies accumulate. Record demand. Flat supply. Gated bridge. Foreign positioning vulnerabilities surface late. Shorts face no willing sellers. Hoarders lock. Producers retain. Covering escalates bids vertically. Thin books yield spikes. Not hype. Observable pressure buildup. For viewers in defense or high-tech procurement, silver's dual role in strategic electronics, retention implications for allied chains. Note, observations and comments. It layers security dimensions. Causes crystallize backward. 5-year deficits met by stock drawdowns, Eastern processing. Policy aligns priorities. Solar dominance, self-reliance. Leak or announcement, effect identical. Window narrows. The fracture propagates inexorably. Inventories trough, premiums embed, prices recalibrate upward. No equilibrium restoration. Scarcity defines new baseline. Process matures, cold and structural, reshaping allocations without declaration. Stability yielded at the refining gate. Deficits inexhaustible, reality asserts. One final gauge for those monitoring deficits. Silver Institute's 117 million ounce projection. Understated given restrictions or buffered by recycling? Weigh your adjusted forecast below. Collective calibration refines the trajectory. Silver trades at $68.76 this evening, up 2.42% on the day after tagging a fresh all-time high of $69.44 in thin holiday volume. That's not momentum. It's the final exhaustion of accessible supply buffers. COMEX registered inventories drained over 47 million ounces in December's first half alone, leaving deliverable stock at levels that no longer mask the physical shortfall, while dealer premiums embed at 40 to 60% for bars and coins as rationing sets in. Quietly, the MOFCOM licensing framework, 9 days from full enforcement, restricts approvals to state-aligned entities clearing 80-ton annual thresholds, calibrating outflows to internal primacy through 2027, effectively trapping 15 to 20% of global refining, flows that once subsidized Western deficits. The recalibration completes. Mine output flatlines near 820 million ounces, recycling contributes marginally. Demand entrenched above 1.1 billion as solar scaling, EV penetration, and AI infrastructure lock in conductivity requirements. Cumulative deficits approach 1 billion ounces since 2021, with China's gated processing compounding an inaccessible Western shortfall exceeding 200 million ounces. This isn't transient pressure. It's the permanent severance of the east-to-west flow that propped paper pricing for half a decade. Industrials hoard preemptively. Asian fabs and module lines bidding without regard for levels, prioritizing continuity in chains where interruptions erase billions quarterly. If you're navigating dealer allocations or physical procurement, the embedded 40 to 60% premiums. How close to outright rationing in your channels? Detail your access constraints in the comments. It pinpoints where availability collapses next. Exposures resolve backward. Bridging leases sustain vault illusions. But alignment with the gate turns lifelines into locks. Positioning data crystallizes insiders insulated long. Outsiders carrying hundreds of millions short. No incremental sellers emerge, as hoarders retain, producers prioritize domestic. Force majeure, provision activate in extremis. Exchanges settle synthetic claims, cash at distorted clears, while tangible commands escalating premia, finalizing the divide between real and illusory. Geopolitics integrates seamlessly. Conductivity's irreplaceability in defense systems, guidance, radars, elevates retention to core resilience. Beijing's prioritization secures 80% solar dominance, input control, as leverage in multipolar alignment. Western buildouts confront sovereignty over dependencies. Diversification trails by years. Costs escalate structurally. For those sourcing in strategic electronics or defense chains, the dual-use lock amid thresholds. How acute the redundant pathway stresses. Log your visibility gaps below. It outlines exposure contours. Structural deficits solidify. 150 to 200 million ounce annual baselines, amplified by discretionary approvals, surpass historical peaks without offset. Revival permitting stifled, substitution bounded, thrifting exhausted. Anomalies coalesce. Peak consumption, stagnant extraction, policy valve. The phase embeds. Bids probe beyond $70 in depleted books. Vacuum pulling toward demand destruction zones. Tangible bifurcates permanently upward. Paper vulnerable to settlement dilution. Cohesion dissolves at the approval threshold. Multiplied claims confront ration delivery. If you've tracked embargo evolutions, the 80-ton qualifiers, protective threshold or de facto quota. Parse the mechanism in comments. Historical matches calibrate endurance. Roots consolidate late. Prolonged drawdowns, depleted above-ground reserves. Policy synchronizes with solar primacy and resource recalibration. No withdrawal indicated. Licenses channel to alignment. Flows internalize. The system settles. Trough inventories irreversible. Elevated premiums normative. Clearing rediscovers absent cross-subsidy. Scarcity defines the enduring baseline, structural and inexorable. Process concludes. Allocation realigns, cold, definitive, complete. One final marker for deficit observers. The mid-December 47 million ounce COMEX drain. Terminal acceleration or residual frenzy? Assess remaining margins below. Aggregated reads lock the transition point.